Now the topic before us is the interplay of reserve requirement and money multiplier. The question is, if there is change in the reserve requirement, what effect it will have on the money multiplier? The answer is, there is inverse relationship between reserve requirement and money multiplier. What is reserve requirement? Reserve requirement is the reserves which the banks have to keep in the shape of cash or as deposits with central bank as mandated by the central bank. The relationship between the reserve ratio and the money multiplier is shown mathematically here. Money multiplier is equal to 1 over reserve requirement ratio. So now we will understand the effect of change in reserve ratio on the money multiplier with the help of an example. Suppose the reserve ratio is initially 10%. So here the money multiplier is 1 over reserve ratio 1 over 10%. 10% means 100 over 10. So it comes is equal to 10. Suppose the reserve ratio is increased to 20%. So it becomes 1 over 20%. In other words, 100 over 20, and the answer comes 5. So you will here observe that if the reserve ratio is increased from 10 to 20, the money multiplier decreases from 10 to 5. So as we increase reserve ratio, money multiplier decreases. We can also say that if reserve ratio is decreased from 20 to 10, the money multiplier increases from 5 to 10. So in this example which is given above, you will realize that here the reserve requirement has been increased and there has been 50% reduction in the potential expansion of money supply. With a higher reserve requirement, the banks are required to hold more reserves. What is this? Suppose bank is having $1,000 as deposits. Suppose reserve requirement is 10%. So the banks have to keep $100 as reserves and they will be in a position to give $900 on loan. So if the reserve requirement ratio is increased to 20%, so the banks will have to keep $200 as reserves and they will be in a position to give only $800 as loans. So the increase in the reserve requirement leaves less money available to banks for lending and subsequent deposit creation. You will see here that when the reserve requirement has been increased from 10 to 20, the amount available for the banks for giving the same on loan decreases. Higher reserve ratio, the lower the money multiplier, lower the reserve requirement, the higher the money multiplier. Now here we are having a question. Calculate the total deposits created if the initial deposit is $1,000 and reserve ratio is 20%. We know that money multiplier is equal to 1 over reserve ratio. So here money multiplier is equal to 1 over 20%. In other words, 100 over 20, and the money multiplier comes 5. So here we are having initial deposit as $1,000. So the total deposits is equal to initial deposit into money multiplier. Initial deposit $1,000, money multiplier is 5, so the total deposits are $5,000. So here there is again one question. If total deposits created by commercial banks is $40,000, so total deposits in this question are rupees 40,000. LRR is, that is the legal required ratio, it is 25%. So here we know that the formula of money multiplier is equal to 1 over reserve ratio. Here 1 over 25%, in other words 100 over 25, and the money multiplier comes 4 in this question. So here the total deposits have been given to us. We know that total deposits is equal to initial deposit into money multiplier. Initial deposits are not known to us. Total deposits are 40,000 rupees. Initial deposit is not known to us. Money multiplier is 4. So initial deposit is 40,000 divided by 4, and it comes to 10,000 rupees. Initial deposit is 10,000 rupees. We hope the questions are quite clear to you, because here we have only used the formula of money multiplier 1 over reserve ratio, and on the basis of the same you can calculate the total deposits or initial deposits accordingly. Thanks for watching. If you like our course, please spare some time to give a star rating to our course.